If you're sitting on a stack of 1099s from Uber, DoorDash, Upwork, Stripe, and a Venmo screenshot from that one client who paid you in 3 chunks, and you're trying to figure out how to put all of that on one Schedule C without accidentally paying tax on the same dollar twice, you are not confused because you're bad at this. You're confused because the rules literally changed in the middle of last year, and half the advice you're reading online is quoting a threshold that no longer exists. Here's the belief I want to kill in the first 30 seconds. Most freelancers I talk to still think that starting in 2026, every dollar over $600 moving through Venmo, PayPal, or Stripe is going to trigger a 1099K. That was the plan. It is not the law anymore. The One Big Beautiful Bill Act, signed July 4, 2025, retroactively killed the $600 threshold and reinstated the old one, more than $20,000, and more than 200 transactions per the IRS Fact Sheet 2025-08 published October 23rd. And that single change quietly created a brand new problem. For tax year 2026, a lot of you are going to receive fewer forms from fewer platforms for the same income you always had. And the IRS still expects every penny on Schedule C anyway. So the question is, how do you reconcile a stack of mismatched forms plus income with no form at all onto one clean Schedule C, without double counting, without underreporting, and without waving a red flag at an IRS matching computer that is very much still watching? Let's start with what actually gets sent to you in 2026, because this is where people trip. The $20,200 threshold for 1099K applies to what the tax code calls third-party network transactions. That's the Venmo, PayPal, Friends and Family Adjacent, Cash App for Business bucket. Payment card transactions are a completely different animal. According to the IRS Form 1099-K FAQs updated in 2026, payment cards, credit, debit, gift cards, stored value, have zero de minimis threshold. A single $50 credit card charge run through Stripe can generate a 1099K. There is no floor. So if you're a freelance designer who took one Stripe checkout for $400 last March, you are getting a 1099K for $400. Meanwhile, the copywriter next to you who took $18,000 in Venmo business payments across 190 transactions gets nothing. Same industry, wildly different paperwork. Your situation genuinely depends on which rails your clients used. And honestly, most freelancers I know have no idea what their own checkout page runs on. Now stack the second change on top of that. Section 70433 of the OBBA, and I'm pulling this from the littler analysis of the bill text, raised the 1099 NEC and 1099 MISC threshold from $600 to $2,000 starting in tax year 2026, with inflation indexing beginning in 2027. So, the client who paid you $1,800 by ACH for a logo project? Under the old rules, they owed you a 1099 NEC. Under the 2026 rules, they don't. You'll get nothing in the mail, and that income is still 100% taxable. The IRS Gig Economy Tax Center is not subtle about this. It explicitly states that all gig income must be reported on Schedule C, even if no 1099K, 1099 NEC, 1099 MISC, or W-2 is issued. Self-employment tax kicks in at just $400 of net earnings. 400, not 4,000. My take, and I'll say this bluntly, the biggest audit risk for 2026 is not the freelancer who gets 10 forms. It's the freelancer who gets 2 forms and quietly forgets about the 6 clients who paid under $2,000 by direct deposit. Don't be that person. Reconcile from your bank statement down, not from your 1099 pileup. Here's the workflow I actually use, and it's boring on purpose. Before I touch a single 1099, I pull a full year transaction export from every business bank account and every payment platform. Stripe, PayPal, Venmo Business, Square, Cash App for Business, the direct deposit account, all of it. I total gross receipts from the money inside. That number, the one your bank tells you, not the one the platforms tell you, is your real Schedule C line 1 before any adjustments. Then, and only then, I pull the 1099s out and check them against that total. If the sum of my 1099Ks plus my 1099 NECs is bigger than my actual bank deposits, something is being double counted. If it's smaller, that's fine. The difference is unreported to IRS income that you still owe tax on. The double counting trap is where most people torch themselves, so let me walk one through end to end. Say you did a $3,000 branding project for a marketing agency. They paid you via Stripe. Stripe processes it, hands you the money, and because it's a payment card transaction, Stripe issues you a 1099K for that $3,000. So far, so good. But the agency's bookkeeper, who has not read Section 6050W of the code, also cuts you a 1099 NEC for the same $3,000 because their internal system flags any contractor payment over $2,000 for a form. Now the IRS has two information returns totaling $6,000 against your Social Security number for one $3,000 job. The IRS instructions for Form 1099-K are explicit. Payments made through payment cards or third-party networks that would otherwise fall under Section 6041 as a 1099 NEC are supposed to be reported on the 1099-K instead, not both. But when it happens anyway, and it will, you report the $3,000 once on Schedule C gross receipts. You do not add them. You do not net them. You report your actual income. And then, if you're getting audited computer letters later, you show them the deposit, the invoice, and the platform statement, proving it was one payment. Real quick aside on this, because I've had it happen to me personally. If a client double issues you forms, email them once, politely, and ask them to void the 1099 NEC and reissue a corrected one showing 0. Half of them will. The other half will ghost you. Either way, you keep the email as documentation, you report the income correctly once, and you move on. The IRS matching system flags mismatches, but a clean paper trail beats a panicked amendment every time. Let's talk about the sneaky one: state thresholds. The IRS FAQs updated in 2026 note that states can impose lower 1099K thresholds than the federal 20,200 rule. Massachusetts, Vermont, Virginia, Maryland, Illinois, New Jersey, and DC have historically had lower thresholds, some as low as $600. So if you live in one of those states, your platform will issue a 1099K to satisfy state reporting, even if you're nowhere near the federal number. That form still shows up in the IRS system. It still needs to reconcile to your Schedule C. Your state of residence genuinely changes what paperwork you get, and I've watched Vermont freelancers get blindsided by this 3 years running. One more edge case that catches people: backup withholding. If you ever failed to give a platform a valid W-9, maybe you signed up with an old address, or your TIN didn't match, the platform may have been withholding 24% under Section 3406. Per IRS Publication 1099 for 2026, if a TPSO performs any backup withholding, they must file a 1099K and a Form 945 regardless of whether you hit the 20,200 threshold. Translation: if you had backup withholding, you're getting a 1099K no matter how small your volume was. And that withheld amount goes on your 1040 as tax already paid. Do not forget to claim it. I've seen freelancers leave $800, $1,200 on the table because they didn't realize the withholding line even existed. The other 2026 wrinkle worth knowing, this one's more procedural, is that the IRS is retiring the old fire filing system at the end of 2026, and IRIS becomes the only intake channel starting filing season 2027. And the revised Form 1099K adds a new Box 1D for Treasury-tipped occupation codes, which is how rideshare and delivery platforms are going to report tip income separately so drivers can claim the new no tax on tips deduction that came out of the same OBBA bill. If you drive for Uber or deliver for DoorDash, look at Box 1D on your 2026 form. That number matters for your deduction eligibility, and it's brand new. Nobody had this box last year. Now, quick historical context because it helps to understand why the rules are this messy. The $600 1099K threshold came from the American Rescue Plan Act in 2021. The IRS delayed enforcement 3 times, 2022, 2023, and 2024, because platforms and taxpayers were nowhere near ready. Then Congress just repealed the whole thing retroactively in July 2025. Section 70432 of the OBBA made the 20,200 threshold retroactive all the way back to 2022. So, if you filed an amended return in 2023 or 2024 based on a low threshold 1099K, that form technically shouldn't have existed. I cover taxes and retirement for self-employed workers, and I've never seen a threshold get whipsawed like this. Don't feel dumb for being confused. This was legitimately chaotic. Here's what I'd do for 2026, straight up. Open a spreadsheet before December 31st. 4 columns. Date, payer, gross amount, platform. Fill it in monthly from your bank export, not from memory. When 1099s arrive in late January and February, add a 5th column marking which form covers which deposits. Anything not covered by a form is still income. Highlight it yellow and it still goes on Schedule C, Line 1. Your total gross receipts should match your bank deposits exactly, minus any refunds you issued. If a client double-issued forms, note it in the margin and keep the invoice. That's the entire reconciliation. It takes maybe 2 hours a year if you do it monthly, and it turns a scary pile of mismatched paperwork into one clean number. Individual variation matters here. Your filing status, your state, whether you have an S-Corp election, whether you're on cash or accrual accounting, all of that changes downstream math. But the reconciliation itself is the same for everyone. Bank first, forms second, difference explained. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared up the 1099 mess for you, hit subscribe. I put out one of these every week specifically for self-employed folks who don't have an HR department. If there's a specific 1099, Schedule C, or quarterly tax situation you want me to break down next, drop it in the comments and I'll pull it into an upcoming video. Next week, I'm tackling how to actually invest that 1099 income, specifically whether self-employment earnings count as earned income for a Roth or traditional IRA, and where most freelancers leave money on the table. See you then.